All right. Today is Monday, November 14th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. I hope everybody had a great weekend. But hey, if you didn't have a good weekend and you had a horrible week last week and maybe a bad Monday so far, I'm going to make you feel a little better here by asking you to think about what you think about, man.
Think about what you'd think about.
Think about what you think about if you were Tom Brady, for example. With the implosion of the Tulip market, and FTX in specific. The headline reads, Tom Brady and Gisele Bündchen put their $650 million fortune into maximizing their stake in FTX cryptocurrency. Whoops. And let me fix this headline for you. Here it is. Yep, it's only Tom. Read the prenup. The guy gambled his entire football fortune on tulips. And now he lost. But hey, losing $650 million, that's nothing compared to losing your nuts. Because the guy was about to lose his over the weekend. I don't know if you saw this or not, but look at this. Look at the margin of error. But rest assured, folks say that Tom already lost his balls long time ago. We got the confirmation today with Gisele dating the personal trainer. Oh yeah. So you might think that you had a bad weekend and a bad week last week, but it's nothing compared to Tom Brady. Unless, of course, you yourself happen to be a Tulip investor, then you probably had a worse weekend than Tom. And Market Watch says, don't let Tom Brady lead you astray. Big names hawking FTX and other crypto investments can mean only one thing for your finances. And that thing is, kaboom, your money is gone. It's in the Bahamas right now, or Argentina or whatever. But listen, having a bad weekend, a bad week, that's the name of the game. But some folks are having a bad year so far. Can you imagine that? One of these folks happened to be Mama Cathie Wood from RKKKKK, which is blowing up. And Mama Cathie came out today and said the Fed made a serious mistake by raising interest rates and it could land the U.S. in another Great Depression. The only Great Depression happening right now is in your fund, Mama Cathie Wood. But hey, the Great Depression can be fun. Waiting in bread lines, making friends. That's a lot better than living in the metaverse. But of course, the outlooks for inflation differ. And it all depends whether somebody's holding a bag or not. For example, Goldman Sachs says that inflation will drop significantly next year. So inflation goes down, the Fed doesn't have to be as aggressive as we thought before. And boom, the stock market goes all the way back to the moon, baby. All-time highs. The problem is, they're not telling you why inflation is going to go down. Inflation is going to go down for the wrong reasons, such as the Great Depression that Mama Cathie's talking about. And in reality, inflation is not going to go anywhere. History says it could take more than a decade to get it down to normal. There you go. But of course, the market remains euphoric in the aftermath of the CPI that inflation is peaking, finally, for the 50th time this year. But this time is the real deal. Don't ask any questions. Just put your blindfolds on and buy. Because the seasonality, if it's not inflation going down, the seasonality is good. But here's the problem. We talked about this last night. Inflation expectations continue to move higher, and there is no possible way that inflation is going to go down without inflation expectations going down. And last week, we got the data from the University of Michigan that inflation expectations are actually moving higher again. And today, we got the confirmation from the New York Fed that inflation expectations for the short and the long term moved higher again. But the market says, hey, I don't care. We want to go higher for whatever reason. Doesn't matter what it is. If it's not inflation going down, it's the seasonality. If it's not the seasonality, it's the Santa Ratty. If it's not the Santa Ratty, it's something else. Just make up something. It doesn't matter. And of course, Nick Timiraos, the Fed whisperer, as they say, even though he got his information wrong. Before the FOMC, he said that, or he hinted, that the Fed is talking about slowing down interest rate hikes. And I told you, my sources say that Jerome Powell is going to come out with the hammer. And he's going to smash your little head. And he's going to put an end to all of this pivot bullshit. And that's indeed what happened. So I say my sources at the Fed are better than Nick's, but who cares? Nick says that the New York Fed survey of consumer inflation expectations shows they moved up, i.e. the wrong way last month, reversing several months in which inflation expectations fell. Hello. And the reason for this stupidity is financial conditions continue to loosen. Every rally in the stock market loosens financial conditions. And of course, as a result, inflation expectations move higher again. And now the Fed is sending not the top guns, but let's say the B lists for now. And last night they got Governor Waller out and he said that the market has overreacted to the CPI. We've got a long, long way to go. But the problem is we're getting mixed signals from the Fed. While the Fed wants to play tough and say, hey, don't overreact here, we're not through with the fight against inflation. Some of the geniuses at the Fed, they come out, and these are the doves. They've been doves all along. All of their hawkish talk is fake. They're just going with the program. And now we're seeing some defection at the Fed. We're seeing the doves taking their hawk masks off. For example, today the vice chair, Mrs. Braindead, came out and said that the time was soon coming for the central bank to moderate the size of its rate hike increases. However, it was not yet ready to pause. So you're speaking with both sides of the mouth. And you know that the market is a junkie, is an addict to the drugs from the Fed. When the market hears this wishy-washy talk with both sides of the mouth, they say, okay, the Fed is going to capitulate, the Fed is going to pivot, and let's buy. And as a result, financial conditions loosen, inflation expectations move higher again, and then the Fed will have to come out even more aggressive. And we continue to play this game over and over and over again until something is going to break for real this time around. Now look, I listened to the conference by Jerome Powell last time around, and I thought that he was clear that the pace of interest rate hikes doesn't matter anymore. If they do 75, 50, that doesn't matter, because the ultimate rate at the end of the day is going higher. So now Waller says, yeah, we might cut the size of the rate increases, but we're not softening the fight against inflation. In other words, the rate is going higher and higher and higher. So what is all the fuss about? What is all the excitement about? Oh, that rate hikes might go down from 75 to 50, but the ultimate rate is going higher. That doesn't make sense at all. That's just like the market being excited about, hey, you're gonna get executed in December. But instead of doing so by throwing you in the lion's cage at the zoo, we're gonna give you the jab instead. And this is not any jab. This is the real booster. It'll boost you all the way to the afterlife. And is this really a reason for excitement? You're gonna be dead either way. That's the end result. Whether you're thrown in the cage full of lions or you get the afterlife booster. Doesn't matter. You're dead. Matter of fact, you're better off being thrown at the lion's cage because, hey, at the end of the day, you might be a lion whisperer. And you'll make friends with the lion, and you live after all. Folks, I have no idea what I'm talking about right now. But what I know is we have an important development to talk about in the In Focus segment of this program. But before we do that, a word of thank you to all of the new members in this channel. Thank you so much. The response last night was overwhelming once again. And a note to the Top Gun Mavericks, thank you for joining. And apologies to those who joined and did not see their names in the credits by the end of the video. I'm going to work on this tonight after I'm done with this program. And all of your names are going to be there when I'm done. And with that out of the way, let's move on to the main segment of this program. And here it is, In Focus tonight. You're fired. Here comes the tsunami of layoffs. And look, about 5 months ago, I produced a video saying, get ready, the tsunami of layoffs is coming. A lot of folks said, hey, what's up with the FUD, bro? You're lying. You're making stuff up. This is just clickbaiting. How about now? And we're just getting started, baby. Today in the morning, we got the news that Amazon is planning to lay off approximately 10,000 employees. Gone. You're fired. Goodbye. And this happens to be the largest layoff in Amazon's history. And you know who else is getting fired? It's oligarch Jeff Bezos' publicist, because they told him this is the day today where you're going to announce that you're going to give away a bulk of your $124 billion fortune. The same day Amazon is announcing getting rid of over 10,000 employees. And Amazon is not the only company getting rid of employees. This comes on the heels of Disney announcing freezing hiring and expecting some layoffs. And by some, they mean thousands of employees. And of course, we got the news a few weeks ago that Meta is getting rid of 11,000 employees. And they're doing it in the most vicious way. The headline reads, the software engineer from India says he was fired by Meta 2 days after he moved to Canada for his job. Whoops. But hey, at least the weather in Canada is good this time of the year, right? And of course, Mark Zuckerberg doesn't care. When he fired the 11,000 employees, he put the makeup on, he pretended that he's crying. And of course, after the conference was over, he went back to surfing in the metaverse. And now all of these oligarchs are saying, we apologize, we're sorry, we overhired, and now we have to get rid of you. At least they're pretending that they care. But one oligarch doesn't even pretend that he cares. And this oligarch, of course, no surprise, Reverend Elon Musk, who's firing people on the spot, who's firing people via Twitter. He's tweeting that he's firing folks. Today, he says that he's getting rid of Twitter for iPhone labels. You see, when you tweet right now, it shows, oh, a tweet came from an iPhone or from an Android. And of course, it's embarrassing because if you tweet from anything other than an iPhone, what are you, poor bro? You can't afford an iPhone? You're tweeting from an Android? What's wrong with you? So Elon is getting rid of the shame labels entirely. And in response to this, a programmer on Twitter said, I have spent 6 years working on Twitter for Android and I can say this is wrong. Wait a minute, you worked 6 years to add a label whether a tweet came from an iPhone or an Android? What's going on here? And of course, Elon Musk fired the guy via tweet. He said he's fired. Goodbye. Gone. See, if you work in Twitter, be careful of hurting the ego of your boss, because he's an egotistic maniac. If you hurt his fragile ego, you're going to lose your job. And Elon is already facing a massive backlash. Today, Senator Ed Markey, whoever the that is, said to Elon, fix your companies or Congress will. Is this part of his stand-up routine because Congress is going to fix companies now? Dude, Congress needs fixing. Why don't you start by fixing your own house? And we know that these massive layoffs by the tech oligarchy is happening because tech stocks have been crashing. But rest assured, Mark Cuban, another oligarch, comes out and says, investors are not facing another dot-com crash. Nothing is happening here. Dude, we have stocks that crashed already. Over 95% from the top. And now this guy who's been pumping tulips, by the way, he comes out and says, oh, this is not the dot-com bubble all over again. And I say maybe we should have a TV show called America's Got Talent Oligarch Edition. Because you see, back in the day when the oligarchs were oil and tobacco people, yeah, they were nasty, but they were not sadistic. They didn't need to see human suffering to be pleased. But these big tech oligarchs, once upon a time, they used to be nerds, and people picked up on them, and now they have a grudge, and they want to see human suffering, and they feel excitement and sexual pleasure from human suffering. For example, in the America's Got Talent Oligarch Edition, Jeff Bezos will see who can hold their piss for the longest. And maybe if you win by holding your piss for more than 8 hours, you're going to win the Bezos Courage and Civility Award. Oh, wait a minute, he already gave it away to Dolly Parton.
Talk to me about choosing Dolly Parton.
Well, look at what she's done and how she's led her life. And the way she's done it, these bold things, always with civility and kindness. She's a unifier. You know, we have big problems in the world. And the way to get big problems done is you have to work together. We have too many examples in the world of conflict and people using ad hominem attacks on social media and so on and so on. You won't find Dolly Parton doing that.
Wait a minute, so he's giving it to Dolly Parton because she's nice on Twitter? She's not mean? How about giving some of that money to the employees you just got rid of?
And when you think of Dolly, look, everyone smiles, right? Yeah. And all she wants to do is bring light into other people's world. That's all. And so we couldn't have thought of someone better than to give this award to Dolly.
Oh, shut the up, bitch. What do you know about all of this? Just enjoy your sugar daddy. All of a sudden, she's a philanthropist. Oh, we're going to do this, we're going to do that. We know why you people do all of this charity. Not because of the goodness of your heart. Because of tax cuts. Because your lives are empty. You've done everything that a human being can do. You traveled all over the place. You enjoyed all of the pleasures. Mansions, cars, jets, yachts, everything. And your life is now boring, so you need another thing, another source of excitement. And with charity comes all of these events where you get to dress up and meet other empty oligarchs and drink expensive wine. That's what it's all about. It's not about charity at all. And by the way, Bezos has the audacity to come out and say that consumers and business owners need to reduce risk in the face of a likely recession. Does that include the small businesses that you destroyed all over the country? Or is it just the corporations? I'm just making sure here. You see, in the media and in schools, universities, they teach you this propaganda that all of these oligarchs became rich because they're smart or because they work harder than everybody else. That's bullshit. You know how this guy got rich? He creates a business, which was a failing business to begin with, but it benefited from the dot-com bubble, the insanity. It was a glorified bookstore online that everybody thought it was a joke to begin with. And then came the easy money policy courtesy of the Fed. The Fed flooded the system with easy liquidity, money all over the place. And unfortunately, this easy money is not accessible to you and me or small business owners. It's accessible to public companies in the stock market. And of course, a company like Amazon, even though they've been losing money for years, they can access cheap loans and expand. And when they expand, we see their revenues increasing. We see growth in the company's revenue. But the company's not making any profits. But under the quantitative easing era, that did not matter. It was all about growth at any cost, which means all of the money from the hedge funds, from the pension funds, from retirement funds is flowing into growth. Companies like Amazon, and they get bigger and bigger by this Ponzi scheme, and they can afford to take on even larger loans and expand even more. And they can afford to underprice mom and pop businesses because it doesn't matter for Amazon if they report a loss for the quarter, for the year, so long as they continue to expand and grow their revenues. But can you do this as a small business owner if you happen to be a mom and pop? Can you afford to lose money year over year and stay in business? Of course not. Can you afford to lose money year over year and get access to loans, cheap loans, interest-free loans? Of course not. And after years of underpricing mom and pop businesses, Amazon succeeded in destroying small business in America. The American dream is dead, courtesy of Amazon. And when you have no competitors at all, the field is free. You can expand all you want. You can have the pricing power. You can jack up prices. It doesn't matter. You can afford to build these giant warehouses across the country. You can afford to hire thousands of delivery fleets all over the country. And the next step is becoming a monopoly. This is how Amazon became successful, not because Jeff Bezos is smart or hardworking. That's all bullshit. That's all propaganda. And only now we're seeing the ramifications of quantitative easing by the Fed. Companies who did not make it, like Amazon, because inflation popped out of nowhere. Of course, we know it popped because the Fed decided to print on steroids in response to the Thing crisis in 2020. They unleashed the biggest tsunami of liquidity in human history, and that produced inflation. That is the main reason we have inflation worldwide. When the world's central bank decides to go insane, print on steroids, trillions and trillions of dollars, of course we're going to have inflation. And now that inflation is here, they have to kill it. And they're killing it by increasing interest rates higher. Now, is that going to hurt Amazon? Maybe a little bit, but they're going to survive. But it's going to hurt Amazon's competitors. It's going to hurt whatever left in mom and pop businesses. It will completely annihilate all of these zombie companies, aka startup companies, that followed the same path as Amazon, growth at any cost, rack up the balance sheet with debt because money's free. The problem is, unlike Amazon, the timing is wrong. They ran out of time, and now interest rates are moving significantly higher. This debt is going to cost them a lot more. Meanwhile, their growth is slowing down. Now that quantitative easing is over and we have quantitative tightening, the investment philosophy shifts from concentration on the growth in revenues to the growth in profits. And you got all of these startup companies with no profits, with slowing revenue, and a lot of debt on the balance sheet, with interest rates moving higher. The end result is they're gonna blow up. So now you have an environment where Amazon competitors are being blown up. Mom and pop businesses, whatever left of that, getting blown up, and startup companies also getting blown up. The field is going to be free when this is all said and done to Amazon to do whatever they want to do, to expand limitless, to take the ideas of all of these startup that went dead, and they're going to revive all of these ideas under the Amazon label. Amazon is going to be the winner of all of this. And unfortunately, this is the reality of this Hunger Games economy that we're in. We only got here because of trickle-down economics and because of the Fed's engineering of the financial system, which, by the way, cost this country over $30 trillion in debt. You want to talk about a booming economy? How about a kabooming economy? Because that's what it really is. And before we move on, let's give you a tulip market update. Here it is.
Fortune favors the brave.
By now, you might be aware that FTX went kaputs. Tens of billions of dollars gone. Poof. And of course, we all knew that this is coming. We should have listened to the kiss of death by Jim Cramer, who compared Sam Bankrupt-Fried to J.P. Morgan. And that should have been the moment where we should have recognized that this is the beginning of the end of FTX and Sam Bankrupt-Fried. It's not going to stop here. Goldman Sachs says, stop panicking about Coinbase. Coinbase is fine. It's insulated from FTX collapse. But we're still cutting the target to $41. But nothing to see here. Don't panic. It's okay. And another tulip exchange called Crypto.com accidentally sent $400 million in Ethereum to the wrong address. And when people raised the question that Crypto.com could be the next tulip to be blown up, the CEO came out and said, all of these concerns are FUD, misinformation. And by the way, just like Matt Damon, I was a benefactor of Crypto.com because they advertised a lot in my channel. And that brought in a lot of money, baby. But now you don't see Crypto.com ads in my channel anymore. You know why? Because they're going down too. And of course, even Binance is now being threatened of going under. Now, we're not talking going under to Australia. We're going under meaning kaput's gone. And now we're seeing customers withdrawing money from Binance. But the CEO came out and said, no, don't panic, this is FUD. Business as usual here. Nothing is going on. Nothing to see here. And I say that the collapse of FTX is just the beginning of the end of all of these Tulip exchanges. They're all over-levered, number one. Number two, they have these billions of dollars stashed in their own coin. Where's the hedging here? But rest assured, we have to end on a positive note. And this positive note is the retail mom and pops, they remain sheepies. And the sheepies plowed in over $43.3 million into cryptocurrency-focused ETPs last week. Now, what does that mean in plain English? It means mom and pop investors bought the dip in tulips. They're not deterred. They're not afraid. They're going all in to the slaughter. And with that positive note out of the way, let's move on to the coverage of the stock market. We begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 211.16 points, or a decline of 0.63%. The Nasdaq leading the pack to the downside, down by 127.11 points, or a loss of 1.12%. The S&P down by 35.68 points, or a decline of 0.89%. When it comes to the sector's performances today, all in the red for the most part, with exception of healthcare, which managed to capture the gold, the silver, and the bronze medals today. On the other hand, the laggards were led by REITs, cyclicals, and utilities. Of course, the bond market was closed during Veterans Day, and now we have the opening, and yields shot up higher. When yields go higher, real estate, utilities, they go down. But the question here remains, are yields going down for the long run? Have they topped or not? Because if they did, and if this rally is induced because yields went down, then it should be led by REITs and utilities. But the fact that we have REITs and utilities lagging is a warning sign that perhaps yields might shoot up higher. When it comes to the advance to decline ratios, NYSE 33% advancing versus 66% declining. The Nasdaq 41% advancing versus 57% declining. On to commodities, and it was a bad day for energy. Crude, be it the WTI or Brent, were down big. The WTI was down over 4%. Brent was down almost 3.5%. We'll talk about why in a second, but gasoline was down. The RBOB was down almost 3.5%. Heating oil pretty much in the flat line. On the other hand, the party boy, natural gas, closed with gains of almost 3% for the day, but it was initially much higher. It was up by more than 8%, and then it came down. So let's talk about why. The reason why the WTI and Brent were down, we're talking about crude oil here. OPEC came out in the morning and said that there is considerable uncertainties in the demand for the oil market. So if they say the demand is down, you're going to see a negative reaction in the futures right away. But this could be interpreted both ways, because if OPEC sees considerable uncertainties, quote unquote, then doesn't that mean that they're going to cut supplies at some point, perhaps in the next meeting? We know we have plenty of demand in the pipeline, at least in this country. At some point, we're going to have to refill the SPR. That's demand, yet OPEC Plus will continue to cut supplies. So I don't see the announcement by OPEC today as a negative. If anything, it's a positive in the long run. And here we have yet another catalyst, which is the cap on Russian oil. That could happen any minute now. It's supposed to happen this winter. And of course, Janet Yellen is now in India pitching the price cap because India happens to be the biggest consumer of Russian oil right now. And Janet Yellen said to India, you can buy as much Russian oil as you want, but there is a catch. In doing so, however, India must not violate Western insurance, finance, and maritime services that are subject to the G7 price cap mechanism. And this is according to Janet Yellen in an interview with Reuters. And she also added that India can also purchase oil at any price they want, and that as long as they don't use these Western services and that they find other services, and either way it's fine. Either way it's fine? So what does that mean? India is now among the largest buyers of Russian oil. Russia's share in India overall oil imports now stands at 12%, up from a minuscule 2% at the beginning of the year. And by the way, how is that sticking it to Putin going on? Because look at this. Russian seaborne oil exports have reached almost all-time highs. It's not just the Indians buying. It's the UK, it's Europe, it's everybody. Because this is what happens when you have a price cap. When you announce it to everybody, the demand gets front-loaded and we see prices going higher. And this is overall good for Russia because it makes price caps useless. If you're buying now, you're not buying under the price cap. And of course, the Indians are not going to comply with any of that. Now, when it comes to natural gas, the problem that we got today, initially, natural gas was up by almost 8%, and then it went down in a flush. And the reason is we got news that now the Freeport LNG facility, well, that's not going to reopen anytime soon. And I say, look, this is already priced in because natural gas is down big from the peak. But again, folks are going to sell natural gas either way until we get another catalyst that pushes prices higher. And this catalyst will happen from the weather. If we get news that we have a major winter storm coming, you will see natural gas popping higher again. But look, we must address this because it is important. The dollar went down big in recent days. Yet commodities, yes, they went higher, but the response was muted. What is the reason behind that? My hunch is, and I've been telling you this for a while now, but I announced it on Friday. I said I'm getting rid of my LMT shares, at least half of them, because we have serious talks, serious rumors, at least for now, that the war is going to be, I don't want to say over, but maybe we're going to have a peace deal, be it temporary, be it long-lasting, I don't know. But the United States is in serious talks with Russia regarding a peace deal. And even Ukrainian clown Zelensky came out and said that the recent liberation of Kherson is the beginning of the end of the war. So what is he saying here? Because the media and the war propagandists, they say, oh, he's saying he's going to beat Russia. It's the beginning of the end, meaning kicking Russia out. But you're not paying attention to what happened before that. What led to the softening in the tone? And you might say, hey, Maverick, there is no peace deal. What are you talking about? This is Kremlin propaganda. I'm actually getting my propaganda from the CIA official newspaper, the Washington Post. And the headline reads, U.S. privately asks Ukraine to show it's open to negotiate with Russia. And it also says, White House says lines of communication with Russia are still open. Now, why would they publish anything like this at all? These are supposed to be private talks for now. They only publish them to butter the public for some sort of an announcement. Now, I don't know if this is going to be long-lasting, like I said, or temporary, who knows. But if there is a deal, we're going to see inflation in commodities moving down, meaning we're going to see a mini crash in commodities. The problem is, when we talk about compromises, which side is going to do what and let go of what, it becomes really complicated. And it becomes, okay, there is no path here. There is not going to be a long-lasting deal at all. If that is the case, then inflation in commodities will stick, if not move higher again. Back to the futures, let's look at grains and softs. And OJ futures down big, almost 4% for the day. Coffee futures down almost 2.25%. Cotton futures down over 3% for the day. On the other hand, the winner in grains, oat futures up by almost 2% for the day. When it comes to metals, they're really sensitive to the movement in the US dollar. When the dollar goes higher, they go down. When the dollar moves down, they go higher. Today, the dollar was initially higher, but pretty much flattish, no major movement here at all. And we continue to see gains for gold and silver, be it modest. On the other hand, the most sensitive metal to the US dollar is copper, and copper was down almost 3% for the day. So is this a leading indicator that the dollar is done moving down here? We'll see. We're going to look at charts in a minute, but before we do that, how about nickel? And nickel moved significantly higher today. In the US, it was up by almost 4%, but across the Atlantic, in the UK, was up by almost 7% for the day. So when we talk about peak inflation and the input cost for car manufacturers and battery manufacturers is done, these are all fantasies, they're hopes and dreams. And so long as commodities inflation continues to stick and move higher again, there is no end in sight to this inflation. And if there is no end in sight to this inflation, do you really think that the Fed is going to pause raising rates or cut rates at this point? You got to be delusional. And lastly, when it comes to meats, flattish across the board, no major movement here at all. Both feeder and live cattle futures on the flat line. On the other hand, lean hogs futures closed with gains of almost 1%. Moving on to the big casino, the options market. What's going on here? Remember what I said before, in every bear market rally, there are 4 stages. Stage number 1, the short covering rally, which is followed by a gamma squeeze, meaning in the options market. And then we see the quant funds, and these quant funds react to technicals. And this time around, they reacted right away, along with the short covering. So we have 2 steps already done. Step number 4, of course, is retail mom and pops joining the rally. And that usually happens at the end, and they end up holding the bag. But the important step here in the sustainability of the bear market rally is the gamma squeeze. And the question is, are we seeing volume of options traded moving higher or lower? And if it is moving higher, is it moving higher because of folks buying more calls or not? If the answer to that is yes, then we have a gamma squeeze. We're going to see a gamma squeeze. Yet when we look at the volume for options traded today, the volume remains muted, and the put to calls ratio is not that encouraging at all, at least not right now. Regardless, at number 1, the hottest table by far was Tesla, with around 1.7 million contracts traded today. About 55.5% of those were calls. At number 2, Amazon, with around 1 million contracts traded today. About 68% of those were calls. Apple at number 3, with around 950,000 contracts traded today. About 52% of those were calls. Now notice that the call options ratio for Amazon is a lot bigger than Tesla or Apple. And the reason is, number 1, you have folks chasing the rally by buying calls. Amazon is already up big since the beginning of the bear market rally, so these are the Johnny-come-lately. But there is another side to this. The implied volatility in Amazon's options is really high, meaning call options are really expensive. So folks who own the stock or the dealers, they're writing a lot of call options. Who are the dummies who are going to buy these call options right now? The likelihood is they're going to hold the bag, even if Amazon moves higher, because the premiums are too high. Therefore, we see the put-to-calls ratio more favorable in Amazon. The reason is because the dealer is writing a lot of call options, and folks are buying them, at least for now. And speaking of, here it is, the unusual activities that took place in the options market today, and we start with the ticker AMZN Amazon. Somebody sees more upside coming for the name, and they bought the 108 calls for the expiration date, December 2nd, with expectations that the name could move higher and add more gains of at least 9.5%, if not more. By then, they paid around $1 a piece to enter this trade, all in all spending around $1.6 million. And then what about the ticker NFLX Netflix? Moved higher today, and somebody sees more gains to come. They bought the 325 calls for the expiration date, December 2nd, with expectations that Netflix could add more gains of at least 8.5%, if not more, by the expiration date. And they paid around $4.20 a piece to enter this trade, all in all spending around $3 million. And then what about the trade for the ticker IFF? This is for International Flowers and Fragrances. Somebody sees upside coming for the name here, and they bought the 105 calls for the expiration date, December 16, with expectations that the name could add gains of more than 5.5% by then. And they paid around $2 a piece to enter this trade, all in all spending around $1.3 million. Then what about the ticker NVDA for NVIDIA? Somebody's fading the rip here. They bought the 150 puts for the expiration date, December 2nd, with expectations that the name could move down and lose more than 8% of its value by then. They paid around $4.25 a piece to enter this trade, all in all spending around $1.7 million. NVIDIA and other chip companies moved higher because the dollar went down. But if the dollar is about to go higher, NVIDIA will go down. And then we have the ticker ADBE for Adobe. Somebody again fading the rip in Adobe big time. They bought the 300 puts for the expiration date, December 16, with expectations that the name could move down and lose more than 12% of its value by then. They paid around $5 a piece to enter this trade, all in all spending around $2 million. And lastly, what about the ticker APLS? This is for a company called Apellis Pharmaceutical. Somebody sees upside coming for the name, and they bought the $50 calls for the expiration date, December 16, with expectations that the name could add gains of more than 6.5% by then. And they paid around $3.50 a piece to enter this trade, all in all spending around $1.7 million. On to the heat map. What's going on here? In last night's program, I said, look, on Friday at least, we got a migration from the winners year to date to the losers year to date. We got an exodus from healthcare, for example. All of these big pharma names were down big. We got an exodus from the defense contractors. We got an exodus from the consumer staples, the food packaging companies. Names such as PepsiCo, General Mills, Kellogg's, all of these names were down on Friday. And where did this money flow instead? The answer is buying the dip in trash stocks, the RKK types, the technology cohort. And I said, look, if this is a bear market rally, you don't want to chase tech. Instead, you want to use the opportunity in buying the dip in the names, the good names, the value names, the outperformers year to date when they go down. And these names happen to be the old school big pharma names, the health insurance names, the food packaging names that we covered earnings from. And these earnings were decent. They have the pricing power. The only thing standing against them is the dollar moving higher. Well, now the dollar is moving down. So if you see a dip in PepsiCo or General Mills or Kellogg, isn't this an opportunity to buy? Because these names are not going to reduce prices anytime soon because the dollar went down. They're going to keep the pricing advantage. Their margins will become better. The dollar goes down, yet they're still charging higher prices. Likewise, when it comes to Big Pharma, for example, is there a recession coming for Big Pharma? The answer is not really. Are people going to stop taking their medications because we have a recession? Is the government going to stop paying these Big Pharma names for Medicare? Of course not. So instead of chasing technology and the RKK types and the losers year to date, why not, if you must buy anything, I don't suggest buying a lot here because we're still in a bear market after all, but if you must buy anything, why not buy the dip in the winners year to date? And look at this, Big Pharma names, they moved significantly higher today. Be it Pfizer, be it Merck, be it J&J, AbbVie, all went higher today. But if this bear market rally continues, we're going to see more dips in Big Pharma, in the consumer staples, in oil even, in the defense contractors, because folks believe that this is the bottom. A lot of folks are being fooled here. They're taking money from the winners and rotating to the losers prematurely. This will open an opportunity for all of us. In case you want to buy, you buy in the good names, the outperformers, the names that still have the pricing advantage, but also benefit from a drop in the US dollar. Because when the dollar goes down, you have multiple choices here. You can buy Bitcoin, that's a trap. You can buy chips, that's another trap. You can buy tech, that's another trap. Or you can buy the dips in energy, you can buy healthcare and the consumer staples. You can also buy metals and trade them when the dollar goes down. But remember, metals are cyclical in nature, along with oil. So if we have a recession on the horizon, metals will continue to go down. The difference is when it comes to oil versus metals, oil has a lot of tailwinds stemming from the war and a lot of tailwinds stemming from the lack of supply, be it the green energy policy reducing supply here or OPEC Plus reducing supply globally. Now let's contrast this with the heat map for the ETFs, and as you can see, the majority of names, ETFs, are in the red for the day. The major exception here is inverse indices. Those moved higher today, big time of course. When the regular indices go down, these inverse indices move higher, such as the SPXS, the TZA, the inverse for the IWM, small caps, the SQQQs, the inverse for the Qs. And by the way, we have record inflow in the SQQQs. Now, the institutionals don't usually buy these leveraged indices. They think it's a joke. But the retail mom and pops do. And I'll tell you why. A lot of mom and pops don't have access to options trading. Options trading is scary to a lot of mom and pops. You could lose all of your bet. Number two, a lot of mom and pops have no access to shorting. So when they have conviction that the market is going down, they buy these inverse indices. And in response to this bear market rally, the mom and pops are saying, we're not going to be fooled again. We're betting that this is going to fade. This is yet another bear market rally and then it goes down. So they're going all in buying the SQQQs. Now this makes me a little nervous because you usually do the opposite of the mom and pops. You follow the institutionals instead, the smart money, not the dumb money, and the smart money is actually buying the dip right now, and the so-called dumb money is betting against the rally. But here's the thing, after multiple failed bear market rallies, the mom and pops are starting to learn. And now that we're having the fourth quarter in a losing year, the institutionals, the managers, want to score bonuses. So no wonder why we're seeing the opposite picture here, where the mom and pops are betting against the bear market rally. On the other hand, the institutionals are chasing it. Interesting dynamic here. Now let's move on to the charts and see if they can shed new light on all of this. We start with the SPY, the S&P 500 30 minutes chart. Yesterday I told you we're expecting a pullback, but that doesn't mean the end of the bear market rally or even a reversal. Today we got the pullback. The pattern started to stall, running out of gas, asking for buyers. The buyers did not show up. The momentum indicators, the RSI, the MACD were all overextended and due for a pullback. We got the pullback. And the only damage that I see here is a loss of 398 as support. But we still have soft support at 393.16 and then 391 and the ultimate support at 385.15. We have to see more damage here before we say, okay, this is over. The bear market rally lasted for 2 days. For now, it is premature to bet against the rally because all what you're doing is catching a falling knife. You're buying the puts, and what do you know? The market goes higher again. So why not wait till you see a sign of conviction that this is over and then start buying puts? When we look at the daily chart for the Qs, the continuous contract, what do we see here? No damage done at all. The chart continues to keep 3,960 as support and the resistance for now at 4,100. The volume is moving down, which is bullish, not bearish. The RSI, the MACD indicators, aka the momentum indicators, are moving higher. They're firming up. So we're not seeing any sign of a reversal here. All what we saw so far is the cup and handle formation playing out. The reversal is going to happen if we see 3,855 lost to support. Then we can say, okay, this is maybe the beginning of the reversal, but the confirmation would be losing 3,720.5. For now, none of this is happening. What about the Qs? 30 minutes chart. What's going on here? We have what it appears to be a double top formation for now. We have negative divergence on the RSI. The MACD is moving down on the 30 minutes. We have support at 284.26. We'll see if this is going to hold tomorrow or not. But even if it doesn't, you're not going to see a reversal yet. You're not going to bet against this rally yet. Until we see 280s lost to support, then we have conviction that this bear market rally lost significant momentum. And then you can bet at least for the chart to go down all the way to 269.29. And here's the daily chart for the continuous contract for the Qs. Notice that unlike the SPY, there's not major progress here. All of what the chart did is recapturing the June bottom at 11,058.5, and it's above this support with one support line only. And this support line is 11,689. If that's lost, then we go back to the June bottom. So it is easier to bet against the Qs than the SPY. The SPY is a lot stronger right now than the Qs. Even though the Qs is seeing lower volume, which is bullish, and the momentum indicators are firming up, no conviction yet, no definitive conclusion here that we're seeing bullish momentum. But all in all, the bulls remain in charge for now, until they lose 11,689. Then we talk about the June bottom and the bears start to creep back in. Now, what about the small caps? The Russell 2000 IWM 30 minutes chart. Look at this. We talked about an ABC pattern, which got us all the way to 188. And then yesterday we talked about a bear flag pattern, which should get us down all the way to 185.35 to close the gap. We got there, and the chart went up again in a retest to 188. That test was met with failure, and by the end of the day, the chart closed below the gap at 185.35. Is this bullish or bearish in nature? The answer is it is bearish, not bullish, which means in all likelihood the IWM should go down in a retest of the next support at 183.25. What about the Dixie, the dollar index, the most important chart? Here it is, still negative despite the rebound that we got today. The RSI remains in negative divergence. We need to see a lot here to say that the drop in the dollar is done. We need to see the dollar moving all the way back to 110. Then we're talking. For now, for all you know, this could be a dead cat bounce. And just to make sure, we have to look at gold, which is the most reliable indicator for the dollar. Gold did not go down by a lot. Gold was flattish, indicating that gold, the old man, remains confident that the dollar will continue to go down. But here's the problem. The rally in gold is getting a little overextended. Look at the RSI, look at the MACD, and gold is stalling at the resistance at around 1,763. Is it reasonable to say that gold is due for a pullback? I think it is. And if we say that gold is getting overextended and overbought, isn't it true that the dollar is getting oversold? You put two and two together, we might see a rebound in the dollar and a pullback in gold. Whether that means a reversal or not, that's a different story. For now, we'll take it one step at a time. What about UK oil, Brent, a daily chart? What's going on here? We still have the double top at 98, but we still have support, for now at least. Is it going to hold? Is it not going to hold? We have a lot of negative news that we got today. If the dollar moves higher again, the likelihood is the trend line is going to be broken, and down we go to 85. And I know I'm still bullish in oil, but if you've been waiting on the sidelines, maybe this is not the time to buy. Maybe you have to wait for the dip to happen and see how oil is going to rebound or not from 85. Or better yet, maybe you should wait if this plays out and we see the trend line holding. If Brent oil breaks above 98 and keeps that as support, that would be your confirmation that all is clear now and you have the permission to buy oil. So for now, I repeat, because a lot of folks mistake my bullishness on oil as a signal to buy right now. A lot of gains took place. A lot of folks are going to book these gains. Don't buy right now immediately. Wait for either the pullback or the confirmation above 98. And here's the daily chart for the 10-year yield. What's going on here? The bear flag played out in the vicious way, and now the chart is all the way down to the lower range of the consolidation zone, meaning support. And for now, we got to bounce from this support. Is it going to hold? Is it not going to hold? When we look at the RSI, when we look at the MACD, they suggest that it's not going to hold. If that is the case, down we go to 3.5. And once again, if that is the case and that is the outlook, then which sectors of the stock market going to appreciate the most? The answer is utilities, REITs, home builders. But if we see yields moving higher again, they have a long way to go to prove that the pullback is over. But if that is the case, then the trade is going to be fading REITs, fading utilities, and fading the home builders. Here's the TLT daily chart. What's going on here? Still stalling, still consolidating in a bull flag pattern, just below the resistance zone. In other words, if the TLT is consolidating in a bull flag pattern, it's about to pop any minute now. Doesn't that mean that the 10-year yield is about to go down? What I'm saying for now, the indicators, looking at the TLT and yields, the chart as they look right now, they say TLT higher, yields lower. But remember, the fundamentals also matter. If we have a Fed speaker, perhaps with more credibility, comes out and says, hey, maybe the pivot is not going to happen because inflation expectations are going higher, then we will see the TLT down and yields higher again. What about the VIX 4 hours chart? What's going on here? Yesterday, I suggested that we might see a reverse ABC pattern all the way down to 20. And the bear in me wants this to happen because number one, the put options will become really, really cheap and flipping them for profits will be an easy task. Number two, we get a reliable indicator that the bear market rally is over. But without the VIX going down to 20, it makes things a little more complicated. What we got today is a pop in the VIX, a retest of 24.29 as resistance, and then a failure and a move down. Is it definitive that 24.29 is a no-go? The answer is not really. Look at the MACD, look at the RSI, they're firming again. But to put this argument to rest, let's zoom in here and see what's going on. And we're using the 30 minutes chart, a line chart this time around. What do we see here? Is this a reverse head and shoulder formation? And if it is, then we're going to move above 24.29 in the VIX. Another way we can look at it is, isn't this a larger bear flag consolidation pattern? If that is the case, we're going to go to 20, not above 24.29. Now, which argument has the better case here? Is it the bear flag or the reverse head and shoulder formation? Right now, I say 50-50. If the VIX closed above 24.29 for the day, I would have said the reverse head and shoulder formation has the better argument. But because it closed below 24.29, there is no definitive conclusion right now. What about Apple? 15 minutes chart. What's going on here? We have what it appears to be a double top at 150. 150 is the no entry zone for Apple. The name has not earned it yet. Earnings are not supporting a price above 150. And the question now becomes, okay, 150 is a no-go. Does that mean we go all the way down to 145? That is the conclusion for now. But Apple might have another shot here to give another shot at 150 before it finally capitulates and goes down to 145. If it does, then we'll take it from there. But of course, the bears are hoping for Apple to go above 150, for the VIX to go down all the way to 20, because that would be an easy short. Another easy short would be for Apple to go down to 145 and lose that as support. Then we have a trade all the way down to at least 138.79, if not all the way down to closing the gap at 134.37. Tesla, 30 minutes chart. What's going on here? One way we can look at the chart, yes, it formed a bull flag pattern, and this already played out, but what do we see here right now? Isn't this a trend line that is holding for now? But here's the problem. Look at the RSI. We have negative divergence, and on top of that, we have a lower high, indicating the trend line could be broken any minute now. If it does, we go down all the way to the lows, to the trend line that you see in yellow, which you can see clearly on the daily chart, but we still have a bullish outlook. And this bullish outlook is, if we clean it up a little bit, using a line chart, isn't this a reverse head and shoulder formation? Of course, the bears would say it already played out. I could see it that way, but I'm not going to dismiss it unless I see the trend line broken, the trend line that I just talked about now that we have a lower high. But absent of that, the bullish argument of a reverse head and shoulder formation remains intact. And lastly, what about tulips? Bitcoin, what's going on here? We're still looking for a reverse ABC pattern all the way down to 15,000, and we're using a 4 hours chart here. Does it have to be this way 100%? Does it have to go down all the way to 15,000 right now? The answer is maybe not right away, but for for us to say that the ABC pattern is gone and we're not going down to 15,000 right away, something else has to happen. A rally all the way to 18,000 has to happen. But for now, we're not seeing any sign that Bitcoin is about to rally. And before we wrap it up, let's do updates on charts that are reviewed, let's say within the last few weeks or so. We begin with the ticker BA Boeing. Let's go back and hear what I said about it and come back. And then we have the ticker BA Boeing. This is a daily chart. The name ran in an impulsive rally since October. It used to trade at around 125. Now it's trading at around 170. At some point, this pop is going to run out of gas. My hunch is the resistance at around 173.85 will put a stop to this pop higher, if not even before reaching this number. It is getting overbought in the RSI, so we know that we have a pullback imminent right now. And the trick here is, if you want to bet to the downside, you buy puts on increments. So I bought today. If it goes up to 173.85 and then reverse, and we have a clear reversal, I add batch number 2 to the trade. And even if it goes down right away and I have a confirmation, I'll add more. And the likelihood is, if we have a severe pullback, it stops at around 149, 150-ish. And here's the update. The chart went above 173.85. So I'm out of the trade right now. But are we getting signs that the trade is back on? Sure. Number one, the chart closed below the line of 173.85. If that is the case, we zoom in to a 30 minutes chart, and what do we see here? The support of 173.85 was tested today and it held. But by the end of the day, it was lost again. If that is the case, we go down all the way to closing the gap at 169, that is target number 1, and target number 2 going all the way down to closing the gap at 160. So what I did today is I bought the 160 December puts, and what I'm going to do here is, if the chart goes down to 169 and it loses that as support, then I have the permission to buy batch number 2. If the chart goes down to 160, and it breaks below that support, then I'm buying batch number 3. If the chart rebounds higher and it cracks above 173.85 again, then I'm wrong yet again. And next, let's do Disney because there's a major move here. Let's review what I said and then come back. The ticker DIS Disney. The name is about to report earnings, I believe, tomorrow. What we see in the chart is a double bottom formation. It is facing some resistance here, and this is a weekly chart, by the way. The question is, can it rally based on the double bottom, based on earnings, and retrace some of the move to the downside that it got so far? That is entirely possible. And I think Disney will have a positive reaction here. And of course, this was a major miss here by me. Disney went down big after earnings, but since then it did rebound. So is it back on? My answer is not really. My answer is the closer it gets to 100, the more likely it's going to pull back because the earnings were really bad. And when we look at the chart another way, isn't this a head and shoulder formation? And if it is, it takes us down all the way to the same bottom in 2020. Next, what about EQT? Let's hear what I said and then come back again. And immediately EQT blasted higher, and I believe it closed the day with gains of about 8%. When we look at the weekly chart, it looks as we have a reverse head and shoulder pattern. If that is the case, the next resistance would be 45.5. In the meantime, we can ride the chart all the way higher until it gets there. If it cracks above it, the chart will make a higher high. And here's the weekly chart for EQT. Since then, the name scored gains of about 9% or so. Now it is facing the resistance at around 45.5. We got bad news from Pennsylvania elections. Mehmet Oz did not win. Bad news number 2. We got the Freeport LNG facility news that we got today. That's negative. So we have a lot of headwinds for now, which means if you're not in, wait till we see a break above 45.5 and a closing above this number. That would be a confirmation that EQT beat all of the headwinds and it's about to make a new high. On the other hand, if you're already in the name, if we see a pullback and a loss of 39 as support, then you're going to get out because it means that the headwinds are winning here. We will see EQT testing a lower support, which could be 35. And if that fails, it could go much lower. Next, what about FCX, Freeport McMoran? What about a weekly chart for the ticker FCX, Freeport McMoran? This tracks copper. Now, copper was down today. We're talking about futures. But again, if the dollar continues to go down, this chart is going higher. We're not saying it's going to make a new all-time highs. We're saying how about a retracement all the way to close the gap at around 40.21. But the condition here is the dollar has to continue to go down. Otherwise, this is not going to happen. And here's the update. Since then, the trade is up about 11% or so, not quite to 40.21, closing the gap. But to me, why be so greedy? Especially when the dollar was up today. Why take the chance that this is going to go down if the dollar pops higher? Why not take profits right now? And this is exactly what I did. Now, it could go all the way up theoretically and close the gap at 40.21 if the dollar continues to go down. But for me, this trade is over. It served the purpose and I'm out. Next, what about GM? Let's hear what I said and then come back. Another one, what about GM? This is a weekly chart. Yet again, another double bottom formation. It is moving its way higher. The RSI is firming up, the MACD indicator is firming up, and the challenge becomes at around, let's say 41, 42. That would be stiff resistance, but after that, if the chart makes it, it could add on, after that point, another 10, 15% worth of gains. So this is one chart you want to keep an eye on. If the double bottom is gone, and you know that right away, if let's say 34.5 is gone as support, you know that this is not going to happen, and down we go, the double bottom is not going to hold. And here's the update. Since then, GM is up about 6.5%. It is now facing the Fibonacci resistance. And honestly, we have more bad news here. Number one, Berkshire Hathaway after the bell. Warren Buffett dumped more GM shares. Number two, we now have Mary Barra, who said that GM will be ready for EVs by 2023, meaning the company will be profitable by 2023. Now she says it's going to go all the way to 2025. You might like the technicals in GM, but the fundamentals are not that good. Now, what about Meta? Let's hear what I said about it and then come back. And then we have Meta. This is a monthly chart. Look at this. This is a massacre. This is one for the books. Generations from now, I'm going to look at this chart and study the history. Maybe it's going to be a Harvard case. We'll see. But the point I'm making here is the chart is severely oversold from a daily perspective, from a weekly perspective, from a monthly perspective. What does that mean? It means the risk is to the upside. We could see a massive short covering rally here, but it's going to take one thing. One thing has to happen. It's going to unlock a massive short covering rally. And this thing is Mark Zuckerberg capitulating and saying, okay, no mas, I'm done with the metaverse. We're going to tone it down with the metaverse lunacy. And a little birdie told me that his friends, a lot of billionaires that Mark listens to, are telling him exactly that. So how do you trade it if Mark indeed capitulates and says, okay, we're done with the metaverse? For now, you're catching a falling knife. So the strategy would be buying out of the money calls, let's say in 2023, way out of the money in increments, because we have no idea when the capitulation is going to happen. Maybe more pain has to happen first before Mark capitulates. In the meantime, you don't want to go all in this bet. You want to buy in increments, out of the money, and with a longer expiration date. And when the pop happens, you're going to see these call options appreciating handsomely. Now, Zuckerberg did not capitulate, but the stock moved higher either way. And it moved higher on layoff optimism. And these gains are worth about 20-21%. And for me, I'm keeping those all the way to 2023. Now, if Meta rallies significantly higher and these options appreciate a lot, I'm not going to wait for Mark to capitulate because the purpose of this trade is already served. The purpose was to make money. Well, we made money. Then it's over. We take profits and move on. Maybe Meta is going to pull back again, and that presents the opportunity that maybe we'll see a capitulation re the metaverse. Next, what about MPC Marathon Petroleum? And let's do Valero along with it. Take a look. MPC Marathon Petroleum. Believe it or not, the bullish trend in this name remains intact. That's number one. Number two, it did make higher low. Number three, it is now eyeing the previous top. It is maintaining all of these Fibonacci support levels. The momentum is improving, be it in the RSI or the MACD, and this is a weekly chart. So when we look at the chart, the assumption is at least it should give it a shot in retesting the top once again. And there is no doubt that it will face some resistance at the top. So you don't have to buy right away. You can wait for the retest of the top, see how it behaves. If it passes the top, then we have the all clear that this will make higher highs. And once that happens, once the previous top is defeated, there's plenty of room in the RSI, the MACD indicators for the chart to move significantly higher. Now, how do I know that I'm wrong here? If the chart makes a new lower low in the pattern, and that would be by violating the most immediate Fibonacci support. And then the other chart is VLO Valero. This is yet another weekly chart. Look at the MACD indicator. It is about to cross. It is about to produce positive momentum. Green impressions in the histogram. The chart made a triple bottoming formation, retesting support over and over and over again, and to my eye, the chart is now ready to retest the top once again. You can wait till the retest of the top, but for me, I've seen enough. I'm ready to go in and go all the way and retest the top, being in the name, not waiting in the sidelines. And here's the update for MPC Marathon Petroleum. It made a new high and the gains were about 12.5%. Here's the problem. It is getting a little overextended now, and the likelihood is it moves down to touch the previous high, and then if it rebounds higher from that point on, then you can buy. But if it fails, it will be pretty much the end of this rally. When it comes to Valero, since then, the name scored gains of about 18%. And this is looking a lot better than MPC because it has more room to go to reach the previous high. So I'm sticking with Valero for now, and we'll see what it does when it gets back to the highs. For now, the MACD indicator, the RSI, all supporting more gains to come. And all of these charts are weekly charts, by the way, with exception of Meta, that was a monthly chart. And then what about Netflix, NFLX? Let's go back and hear what I said and then come back. A daily chart for the name. For now, it is overbought on the RSI, the MACD. It is holding onto the support of 290, but the likelihood is, if the Fed comes out hawkish, the dollar pops higher. This is one of the most sensitive names to the US dollar. We covered the earnings and we found out that the company is losing tremendous growth based on the currency impact alone. So if that is the case, the chart goes down to close the gap at 250. That would be an excellent trade. But rest assured, if you happen to be bullish Netflix, nothing will change here, because even if it goes down to close this gap, who's to say that the name is not going to rebound higher in an A, B, C pattern? And eventually it's going to crack above 290 once again and make it all the way to closing the gap, let's say at around 345. And here it is, the ABC pattern on track. The name went down, did not close the gap exactly, but it was good enough. And now we have the C leg, and a lot of gains were made on the downside and the upside. The B leg, the C leg, and theoretically the name could move all the way up to closing the gap at around 345, 340. But look, we have overhead resistance from the previous pullback. So if you made a lot of money buying the C leg, maybe it's a good idea to take some chips off the table. Now, this is the last time I'm going to do an update on this trade because it's already done, in my opinion. There is more room to the upside, but for the purposes of this trade, the ABC pattern, we're done with it. Next, what about Target? TJT. Let's hear what I said and then come back. Chart for the ticker TGT, Target. Now look, if you go to a monthly chart, this is a bear flag consolidation pattern, indicating Target will go down. It will make lower lows. In the meantime, can it catch a rally based on holidays optimism or whatever and retrace the move all the way till the reversal candle? Certainly possible. And that could be a decent gain from the double bottom. The stock could rally all the way north of 180. Why not catch that rally higher? And here it is. Since then, we have gains of about 12-13%. It could go higher all the way to the previous pullback, the line in yellow. Maybe that would be an additional gain of about 2 to 3%. But when you make a quick profit like this, remember the rule. Always be closing, because you have no idea when the pullback is going to happen. A Fed speaker comes out, a piece of macro data pulls down the market and Target along with it. Kim Jong-un firing a nuke, who knows? Would you make quick profits in a short amount of time using call options with short expiration date? Always be closing. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the most important PPI, and then we have the Empire Manufacturing Index, and we have a bunch of Fed zombies speaking. And it will be important to hear what they say. Are they on the side of Jerome Powell, the hawks, or are they on the side of the doves with Brain Dead and Daly and the rest of them, Evans? If we have more doves than hawks, we got a problem here, because the market is going to believe that the Fed is indeed going to pivot. But you all know that inflation is in charge, not the Fed. The Fed will follow whatever inflation feeds them. That's the message of the day. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow.